Well, Figma and and Chime and Firefly Aerospace are among the most notable IPOs of the year. They soared on their first trading days. As investor appetite for IPOs picks up, joining us now, Tom Sosnoff, Tastytrade founder and co-CEO, up 50% from last year, basically. Tom, just rounding up. Is that about right?
That's about right, yeah.
And what is driving that? Yeah, I mean, there was a drought, obviously, but why is it so much more, the market so much more receptive?
Well, it's just like you said, it's years of pent-up demand, and then you also have like this crazy asymmetric speculation out there. There's a lot of money seeking to risk a little, make a lot, and I think it's just, it just draws the noise, it draws the attention. I mean, it's kind of an easy play.
Really? You don't think it's anything more than, if it's nothing more than enthusiasm and that's what we really call sort of fluff, right? Isn't that what you worry about in your market tops? But we're hearing this is a hated rally. So, I mean, you tie it to Bitcoin being at 115,000, and so we're seeing a speculative excess?
I do. It's frothy, it's very, very frothy, and there's probably a lot of red flags in there. But, at market tops or at times like this, you do get a lot of speculative fever. I mean, where can you, basically where can you risk $1 to make $2 or $3? And I think that, especially in the case of some of these IPOs, you're still talking about 100 to 250% volatility when they first come out, which means you're basically risking 1 to make 2. And I think that that's what excites people, or that's what excites a certain group of traders. No question about it.
So you mean most people can't get in on the IPO anyway? No. So you're talking about after the first trade.
Right. Nobody can get in on the IPO. I mean, Tasty is the largest boutique firm in the world, and we trade mostly options. We're a derivative firm, so we trade mostly options, and people are just waiting, until the option markets open a couple of days later. So yeah, you can't get in on the IPO, but you can get in post IPO.
And where do you come down on how a company or underwriters, that it's a fine line between pricing it high enough or low enough to have demand, but not leaving a lot of money on the table? They don't seem to do that great of a job. I mean, if something goes up 300% in one day and then the next day it goes up 20%, is that the underwriter's fault for how they gauge it? What's the perfect number for an opening, do you think?
The perfect number is a higher opening, because most of the people, Joe, you have to remember, most people have restricted stock, most of the insiders. So, and people that have bought from other insiders, usually the minimum hold time on the restricted stock after an IPO is about 6 months. So I think that the fact that they open these obviously a little too low makes the investment banks look good. And I think the insiders are actually happy about it because they get this little burst, they get all this PR. So I think it's all part of it. I mean, obviously, they can price these things better. But I think there's an advantage to the insiders, and I think there's an advantage to the investment houses, to give everybody a little.
I've always thought that, Tom, because if, let's say, I don't know, there's X amount of shares outstanding, and they do a tenth of the outstanding shares happen to have a lot of supply and demand dynamics. It puts it, suddenly the entire market cap of the company is valued at that ridiculous price. And
exactly.
Sometimes it stays there. Yeah.
Exactly. It's like you're setting, you're just really giving an opportunity to set the bar much higher. You're setting it like a new level. That's all it is.
Hey, Tom, I got a slightly different question. It relates to retail investors, but maybe a little off topic, which is there's a big move by this president in terms of changing the composition of people's 401ks so that they would effectively have access to private equity, venture capital, private credit, all sorts of products like that historically have been inaccessible only to accredited investors, people who have $1 million or more, obviously pension funds and the like.
Sure.
Where do you land on this as a big idea and just a practical idea in terms of how well this is going to either work or not?
I have been advocating for this for 25 years. I mean, it's ridiculous in 2025 that we still have these crazy choices in a 401k where you can take a drop-down menu and select, one of, 20 different funds or one of 6 funds, whatever it is. People should be able to be self-directed, make up their own minds, and invest in whatever they want to invest in. And in a world where we're going to be globalized with respect to tokenization, with respect to digitization, with respect to everything, the direction we're going right now, yeah, you cannot limit people to a group of, legacy funds. You have to let people do whatever they want to do. It's their money.
But here's the question, Tom, which is that at least right now, we have specific rules for public companies around disclosure and the like, and we have rules for private companies, which the rules are basically there are no rules. You can do whatever you want.
Right.
And as these things converge, and there's people talking about effectively tokenizing shares of private companies. All of a sudden, yes, that democratizes the process to some degree, but it also democratizes it and creates a new level of risk. No.
100%. Of course it does. But it's also, I mean, how far can you go in telling people what they can invest in and how they can invest? I mean, at some point, you have to open this up and assume that, what we found is over time is that the more markets that you open up, the more efficient those markets get. Like, you're never going to get the private marketplace to be even relatively efficient until you open it up to everybody. Then efficiency will take over. It just, everything works that way. If you want to grow this industry, and I still think we're in our infancy, you've got to open up the markets and, let's see what happens. Let's not be scared of opening up the private markets to, to consumer participation. But there are some rules in place. And I think that, we can tighten those up. We can put a few fences up. But generally speaking, it's a better thing to have it all open than it is to have everything closed.
Let me go one step further then, which is this. There's been an argument that private equity and venture capital are better investments. Let's go with private equity. We'll take venture out because it's a little bit of a different thing. But that private equity is a better investment than the public markets long term. To me, the only reason it's a better, the real reason it's a better investment long term is because or the reason it's less volatile long term is not because it's really less volatile. It's because there's no day-to-day liquidity, and that's what it is a different business model, and that's helpful in some ways, but it's not underneath the hood. It's not that different.
I would agree with you. It's when there's no liquidity and you're basically most private equity. Now, I'm someone that's, built a couple of companies and we've raised private equity, I think, four different times. So I've been on both sides of this marketplace. I think that the fact that the average private equity fund is 7 years, you're right. I just think that takes, anytime you extend duration, you take the volatility or the standard deviation of that P&L out of the equation. So I think it is just a little bit misleading, and it's probably just as volatile as everything else.